Good afternoon and welcome to the 2014 Norman A. Sugarman Lecture. I'm Jonathan Adler. I direct the Center for Business Law and Regulation here, and it's really my pleasure to be here to introduce today's program. This lecture series was established by a generous gift from Mr. Sugarman in 1976, and among other things, it supports a series of lectures on taxation. Norman Sugarman, as some of you know, was born in Cleveland and was a 1940 graduate of this law school. He began his career, appropriately enough for today's lecture, as an attorney in the Office of the Chief Counsel of the IRS and was subsequently appointed the first Assistant Commissioner of the IRS. And upon leaving government service, he returned to Cleveland, becoming a partner at the law firm we now know as Baker and Hostetler. We here at the School of Law have recognized Norman Sugarman as one of our most distinguished graduates, and we're certainly proud to sponsor this program in his honor, and that bears his name. It's also my distinct honor and privilege today to introduce this year's Norman A. Sugarman Scholar in Residence, Donald Korb, who is a partner and the head of the tax controversy practice at Sullivan Cromwell. Like Norman Sugarman, he is a graduate of this law school. He is a veteran of the Internal Revenue Service, most recently having served as chief counsel from 2004 to 2008. And before becoming chief counsel at the IRS, he also chaired the tax group here in Cleveland at Thompson-Hein. I made the mistake of printing out his bio today, and after a few minutes when my printer was finished, I realized there was far more on his biography than I could hope to get through in the brief amount of time you would tolerate my standing up here this afternoon. So there are far more honors and recognitions than I could recount. I would note, though, he, among other things, served as chair of the Cleveland Tax Institute, just one of the many examples of his service to the local bar here in Cleveland, and is a fellow of the American College of Tax Counsel. And maybe of interest to me, he served as a tax advisor to the Kemp Commission on Economic Growth and Tax Reform. And as I said, there are so many other things I could mention, but you're not here to listen to me. Any lecture by me about tax would be exceedingly short, so I will turn it over to Don.
Well, before I begin, I want to mention two individuals who are here who are very important to my career and just recognize them in front of this group. One is Leon Gabinet, who taught me my first tax class, probably down the hall. Actually taught me my first two tax classes. And more importantly, he recommended to the Office of Chief Counsel back in 1973 that I be hired as a lawyer there. So he got me my start in this business. The other is Mal Bank. Mal interviewed me in Washington for a position at Thompson-Hein and Flory. I was taking the LLM program at Georgetown at the time in the evening, in addition to working in the Chief Counsel's office. And Mal fought very hard to have me come to Cleveland. In those days, it was very rare for a law firm to bring in a lateral hire, somebody who had experience like I did. And I'm very fortunate that he did that for me, and along with Leon, obviously played a very significant role in my career. So I want to thank both of you gentlemen for that. As Jonathan said, I served almost 5 years as chief counsel. I was sworn in on April 14th, 2004. We all know what April 15th was, right? Tax day. April 15th, the Cleveland Plain Dealer had the following headline, and I've saved it here. It says, IRS gets it wrong 25% of the time, okay? You can't imagine how many of my former partners and colleagues at Thompson-Hein sent me emails that day. And basically all the emails said something to the effect, you've been down there one day, and look what a mess you've made of things already. The chief counsel job is, in my mind, the best tax lawyer's job in the country. My wife, Pat, who's here, was asked by a reporter from the Wall Street Journal, well, how's he like his job? And he quoted her in the Journal, basically saying, it's like he's 10 years old again, and every day's his birthday. And that's really the way I approached that position. I mean, I was leading the largest tax law firm in the world. Why wouldn't you have a wonderful time doing something like that? And when you add to that, earlier in my career, I was at the IRS 3 different times, where I had a front row seat to history when the 1986 Tax Reform Act was being enacted. I mean, I've just had a wonderful public service career. And adding to that, basically 2 private practice careers, first at Thompson Hine here for many years, and now at Sullivan Cromwell, which is one of the premier law firms in the entire world, you know, New York and Washington. I've just been truly blessed in my career. Now, what I want to do today is 2 things. One, I'm going to look backward over these 40 years that I've been practicing law, since 1974. And I'm going to look at how the law enforcement role of the IRS has changed over that period. I'm also going to look at the role of a U.S. tax advisor and how that's changed. It's changed significantly over that same period. It's kind of interesting how they've kind of moved in tandem. And I've been involved in a number of those changes. So I can really talk from a perspective of somebody involved in the process. And then I want to do is I want to look forward and talk about the future of our tax system and talk about some of the trends that I see happening. But before we do that, I want to just go through a couple of facts and figures, comparing 1974, when I started in this business, and today. In 1974, there were about 1,500 pages in the tax code. And right here is the tax code that I used in Professor Gavinet's class. 1,500 pages. Put up in a moment. Today, we have a tax code that has 5,500 pages. So you can see the difference. Okay? In 40 years, that's what it's come to. In addition, when I was starting in this business, there were 12,000 pages of Treasury regulations. Today, there are over 44,000 pages. In fact, the Wall Street Journal recently took a look at not just the code, not just the regulations, but all this other guidance that the service is involved in putting out: revenue rulings, revenue procedures, private letter rulings, everything. And they added up 74,608 pages of tax law that you have to master if you want to practice tax law today. And to kind of put that in perspective, in 1913, I don't think there's anybody in here who would start practicing them, but there are. In 1913, it was 400 pages. In 1954, it was 14,000 pages. As late as 1995, it was 40,000 pages. And now it's 74,608 pages of law. When I started in this business in 1974, the IRS was organized in a 3-tier structure: national office, regional office, district office. Today it's organized as a national office with 4 operating divisions, each having nationwide responsibility for a distinct set of taxpayers. In 1974, the IRS budget was $1.3 billion. Today, it's $11.2 billion. And more importantly, in 1974, the IRS collected about $270 billion from all the different taxes. Today, it is $2.8 trillion that the IRS collects. One of the things I was responsible for as chief counsel was private letter rulings, which are advanced clearances that you receive from the IRS if you want to do a major transaction. And to kind of put in perspective the change in that area, in 1974 there were 14,000 issued. In 2013 there were only 2,500. And there's a lot of reasons for that. Probably the most important, the fact that these are now available to the public. They weren't in the past. From the late 70s they became available to the public, and eventually people stopped going in for these rulings. The high point, if you're interested, was in 1984. There were 34,000 of those rulings issued. In terms of litigation, which I was responsible for at the IRS, in 1974 there were about 8,800 cases pending in the U.S. tax court, and another 1,100 pending in other courts, district courts, court of claims. In 2013 there were 30,000 cases in the tax court and about 1,000 in other courts. In 1987, right after the high water mark of the individual tax shelter period, which I'm going to talk about, there were 87,816 cases in the tax court. That's just a huge difference in that time period. And I guess the last fact from 1974, on January 2, 1974, the newest IRS attorney in the Office of Chief Counsel was Corbin, 1973 graduate of this law school. One of the things I did when I was chief counsel is when people would retire, I would sometimes give them an award, I'd meet with them, particularly your more senior people, and I began noticing a trend that most of these guys who were retiring were younger than I was. So I went in and had somebody look and see who was still left, who'd been hired by the office before me. There were about 20 people. And I was able to identify that I was the only person who started that week, so I must have been the only new guy there. Okay, so how has the enforcement role of the IRS changed over the years since 1974? And how has the role of U.S. tax advisors changed over that same period? Let's actually go back a little bit further, because you go back to 1965, I have statistics that show that the individual examination coverage rate for that year was almost 5%, and the examination coverage rate for corporations was about 12%. So this was kind of an era that I will call the era of fear, because in those days, individual taxpayers and companies could genuinely fear the possibility of an IRS audit. You had a 1 in 20 chance if you're an individual, 1 in 8 for a corporation. So if you lived on a street with 20 houses, chances are one of those 20 people in those 20 houses was audited. Okay? The largest U.S. companies were audited 100% under continuous audit. So taxpayers were basically less aggressive in those days because than they would be in years to come, because they generally feared the IRS. So it was also almost unheard of in those days for large companies to do any transaction of any significance without going in and getting one of those private letter rulings, one of those clearances. So generally, things were much more conservative. I'd say well into the 1970s, tax advisors at almost all large law firms and the big 8 accounting firms, there were 8 in those days, were quite conservative in their tax advice. And the opinions, both oral opinions and written, were generally not provided to a client unless there was a high probability of success in any litigation which might arise over the issue considered in the opinion. So that was the era of fear, let's call it. Okay? Beginning in the mid-1970s, however, the landscape changed, and tax shelter opinions began playing a more increasing role in the tax shelter marketplace. And so let's call this era, which ran from the mid-1970s through the mid-1980s, the zenith of the individual tax shelter. During that time, a very significant tax shelter industry grew up in the United States, selling tax shelters to all sorts of individuals. And efforts were made by the government to deal with it, but it really was impossible to stem the rising tide. By the early 1980s, I returned to the IRS as the assistant to the commissioner in the 1980s. The IRS was quite overwhelmed by the individual tax shelter problem. And therefore, Congress had to respond to it, and they did so with a very interesting piece of legislation. What they did basically is they limited the deduction of losses from what were called passive activities. And overnight, this shut down the tax shelter industry. It was just stunning how that happened. And it was this change that really put those people out of business. And more importantly, what was supposed to happen with the 1986 Tax Reform Act, it was supposed to take tax considerations out of economic decisions. Decisions were supposed to be made purely on economics, not taking tax into account. Tax sheltering was supposed to disappear. And frankly, for a time that did happen. But it didn't take all that long. Once the use of computers became more widespread, the exotic of modern corporate finance, coupled with the desire of the large public accounting firms, investment banks, and some large law firms to generate revenues not based on traditional billable hours, but based on contingency or premium fees, that naturally led to this new phenomenon called corporate tax shelters. And so we began a period which I'm going to call the era of non-compliance during the 1990s as a result of this corporate tax shelter problem. And interestingly enough, as I look back, and I thought about this when I was chief counsel, why did this happen? Well, there's a lot of reasons. Probably the two most important reasons was on the buy side and the sell side. From the buyer's side, from the individual companies, what was happening was companies were becoming more international, more global, competing in the global marketplace. And to be successful, they had to reduce expenses. They had to reduce costs. And it turned out labor, raw materials were the most expensive, the largest cost, but taxes were the third largest cost for most companies. So naturally, people start taking a look at their tax situation to see if they could reduce those taxes, okay? At the same time this was going on, the big public accounting firms, the investment banks, and law firms realized this, and they started developing transactions which could meet their clients' needs. So what was happening was, instead of a client looking for a transaction, which historically had been the situation we confronted in this business, you had the service providers developing transactions that were looking for clients. They went out and marketed these things. So that was the supply side. And it was a perfect storm. They came together and led to more and more aggressive tax planning during that time period. And the hallmark of these new tax shelters was to develop a transaction that exploited a not too well-known imperfection in very specialized portions of the tax law and produced results that, frankly, if you really looked at it, everyone would say they weren't intended. If Congress had foreseen this, this would not be the result that would be permitted. And frankly, the IRS will correct it once they discover them. And what it turned out is, because of that, most of these probably would not be upheld in court. So what the companies were doing is they were buying transactions that would permit them to take a return position. They were playing the audit lottery. If the IRS didn't pick them up, they won. Even if they got picked up by the IRS, they still might negotiate not paying 100% of their tax. And even if they had to pay 100% of tax, they would only pay an interest charge. So that was kind of the thinking during those days. Another thing that happened around this time was that tax advisors began to look at the law a little bit differently, at least certain tax advisors. What they did was they took a very literalist, strict constructionist approach to interpreting what the law was, as opposed to stepping back and trying to figure out what's the purposes, what was Congress's intention in enacting the statute. They'd kind of put blinders on and just look at the literal words, and they would concoct transactions that would put different pieces together that would meet those literal requirements. But again, if you step back and thought about it, you'd say, well, Congress clearly couldn't have intended that result. And they also began to ignore a whole body of case law that had been developing since the 1930s, what are called judicial doctrines: substance over form, economic substance, step transaction doctrine, business purpose. There were a whole series of doctrines that had been developed by the courts specifically to deal with situations that judges could step back, and if the result in the case really didn't make sense, it gave them an ability to adjust and fine for the government as opposed to the taxpayer. And what happened is these same advisors began telling clients, well, those aren't written in the law. You can safely ignore them. Okay, so you had people putting together these very strict constructionist readings of the tax law and ignoring the judicial gloss that had been put on top of it. Another thing, a lot of these deals, just like the ones in the individual shelters in the 1970s, really made no sense economically. In other words, they were there just purely to save taxes. You would not do it but for the tax savings. So the economics really did not support going ahead, okay? And finally, these were transactions that were easy to replicate. The accounting firms, the other promoters could take these and market them to company after company after company. They were not syndicated, though. They were not syndicated the way the way tax shelters had been back in the days of the individual tax shelter. And the reason for that is really twofold, I think. One was the competition. The promoters didn't want the competitors to know that these transactions were out there. But more importantly, the idea was to keep it secret from the IRS as long as possible. And so in those days, you would find companies being asked to sign non-confidentiality agreements where they would not be allowed to share this with anyone else, amazingly not even with their lawyers, their regular counsel or regular advisors, unless the advisor would agree not to disclose the transaction as well. And there were some other factors too. The emergence of value-added fees, I mentioned that a little bit earlier. Historically in this business, advisors were paid based on the time spent times per hour, okay? But some of the big accounting firms, and later some others, began to mimic what the investment banks did and start charging these contingency or premium fees for certain tax services. And what that led to, think about it for a minute, led to the tax advisor supposed to be giving his or her independent judgment. It really led to them partnering with the client because they had a real stake in whether or not this was going to work. Also, a change that was in 1990 to the advertising rules for the big accounting firms, the ACPA and the Federal Trade Commission entered into a consent agreement that basically permitted the big accounting firms to start advertising, to marketing. And so that put a new element into this because up until that time, the auditors would focus on their clients. They would advise them both on tax and other services, but they wouldn't necessarily go after the other guy's clients. I think it was a much different business in those days, right, Tom? Is that the way it was? But all of a sudden this opened the floodgates and everyone was running around trying to steal everybody else's clients, okay? And so what you really had was a race to the bottom. I mean, as the decade wore on, more and more the big 6 accounting firms, there were 6 by then, more of the law firms, emboldened by what I'm going to talk about next, the perceived weakness of the IRS, and very lack oversight by the licensure authorities, began structuring more and more aggressive tax planning because you didn't want to lose your clients, your business, to the other firm. Okay, so you can just see that happening. Now, while all of this was going on, I've never been able to figure out why, during the Clinton administration, the size of the IRS was cut back dramatically. It was about 15% drop over the period of the administration, but more importantly, about 30% of the people who actually did the audits, the compliance work. And so people understood that and saw that. And so while all this other stuff was going on, the tax cop really wasn't on the beat anymore. And so what happened next was best summed up by a former IRS commissioner named Larry Gibbs. He gave a speech in 2008 to the American College of Tax Counsel. And here's what he said. I believe the cumulative overall impact of these and other similar actions was to increase public disrespect for, lessen public respect of, and diminish the compliance capabilities of the IRS to the point that from 1998 to 2002, there was so little compliance and enforcement presence by the IRS that overly aggressive and sometimes abusive tax planning and the resultant tax non-compliance became so persuasive that Forbes magazine suggested you were a chump if you're not involved in tax schemes. In fact, here's the cover of the magazine that he's referring to, okay? So as a result of all this, when Charles Rosati left his job as commissioner of the IRS in 2002, the tax system was really facing a crisis, okay? In some sense, for some companies and for some individuals, had become a voluntary tax. And so part of as I look back on my tenure, part of what we were doing was trying to reestablish the tax system in a way that people actually would comply with it. Otherwise, if the country doesn't have the money, not going to be able to run the government, okay? Well, in 2002, we enter a new era. Let's call it the era of enforcement. And this is when things really began to change. And the best way to illustrate that is to look at the amount of enforcement revenue that was brought in 2009 versus what it was in 2002. Enforcement revenues, what the name implies, is what the IRS brings in because of all of its enforcement activities. The increase was 43% over that period, a stunning increase. And the actual number approached $50 billion at some point late in that decade. So huge efforts were made to turn this around. And what Everson did is he basically redirected the IRS's focus from being a service organization, providing the forms, providing the tax help, all that kind of stuff, to being both service and enforcement. In other words, they brought the enforcement effort back up. In fact, probably his biggest contribution was to actually have more money appropriated for the enforcement than for the service. And again, based on the numbers I just gave you, you could see it made a huge difference. In addition, and this is where I kind of entered the picture, beginning in May of 2004, the IRS had to deal with this very significant tax shelter problem. Now, the interesting thing about it, as I thought about it, it was kind of too late. A lot of what we did was really too late to impact what had been done. These transactions had been sold, they were out there, the IRS had to find them, had to deal with them. But it was just as important to do certain things, get certain changes to the law made while we were there that maybe wouldn't help us in our job as tax administrators, but 15 or 20 years from now, when our successors fill these jobs, they would have much better tools than we had to deal with this, okay? And so a lot of time and effort I spent, particularly in the litigation, was to think about how we're going to establish precedents in cases that then will be relied upon in the future and try to cut down from this happening again. I can tell you, like clockwork, every 15, 20, 30 years, there's a tax shelter problem. There was one in the late 30s, there was one in the 50s, 75 to 85, the 90s. It'll happen again. And what we were trying to do in a lot of this was to make sure that we had more sophisticated statutes that could help deal with this problem than we had to deal with. Because most of what we were dealing with were statutes that were enacted in the early 80s. So the first thing was to deal with the most egregious tax shelter there was, called the son of boss, and we put out a settlement initiative. The IRS commonly will offer to anybody who invests in a certain class of taxpayers a settlement offer. If you take it, then you know, you'll pay a certain amount, the IRS gets his, and that, you move on. Well, what we did with Son of Boss was kind of unusual. We said basically our offer is you pay 100% of the tax, 100% of the interest, and pay half of the penalty. So it really wasn't a settlement offer, it's more like surrender. But it was such a bad transaction that we felt it was justified, and it really woke people up. All of a sudden now, IRS was back here telling people that if you don't take this, we're going to come after you, and that's exactly what happened. To this day, some of those cases are still out there. The IRS has not lost a single case, and now if they settle it, you can't even get that deal anymore. You have to pay more money. So this was a way to really make a statement that there's a new world out there. In 2004, Congress then enacted what was called the American Jobs Creation Act, and there was a lot we put in there, again, to make changes to the law that was too late to help us, but then would be useful down the road. So that was number 2. Number 3, for the first time in a long time, the IRS started making criminal cases not just against certain taxpayers, but also some of the tax professionals. And I think that really woke everybody up. For the first time now, and some tax lawyers actually did end up going to jail for some of this activity. More that would apply to the rest of us, they beefed up what was called the Office of Professional Responsibility. Everson brought in a former prosecutor to run this, and that's the outfit that we all deal with, that we have to worry about, that they make sure that we follow certain ethical rules, and that has made a difference too, because now that office has some teeth, and people realize there's consequences if you don't follow the rules that are set forth in what's called Circular 230, which are the rules which govern our practice. And then we did a whole series of settlement initiatives where we would then try to clean out all of the deals that were out there. And I played a major role in that. And my big contribution was to come up with a strategic litigation strategy that would put us in a position to do that. And what I came up with was this idea. I took some of my past government experience, my private practice experience, and realized the IRS is in every case. So the IRS can decide which cases go forward and which don't, okay? So let's identify within the 1,000 or 2,000 of this group of cases which ones are the best cases for the IRS to win. Let's do everything we can to litigate those cases, move them up, win 3 of those cases, that's why we call it the 3 and out strategy, and then offer to settle all the rest on pretty tough terms, because people would realize if they went to court, the chances are they're going to lose their case as well. And one of the things I was counting on was something I picked up in practice. There's always inertia where you had a group of taxpayers who were all facing the same, had the same transaction. They'd always want somebody else to pay for it. They wouldn't want that. Company A would rather have Company B spend the money to deal with it. Tom and I, when we used to work on this stuff, we would always tell our clients, it's better, you have the best facts. We ought to go with you. Don't rely on the facts of Company B, because they're going to lose, and then you're going to be tarred with that same result. And I knew that was going to happen, and it did. So time after time, we went into court with this strategy, and we won virtually every case. And of the few we lost, they were later reversed on appeal. And the best example of this was what was called the Lilo-Silo group of cases, lease in, lease out, sale in, lease out. The first case was decided in January of 2007. Interestingly enough, the firm I'm with right now were the lawyers for that case. And it's kind of surprising they hired me after, because I kept making fun of them. This Wall Street firm, they didn't know what they were doing, blah, blah, blah. But they lost that case. In April of the next year, 2008, that case was affirmed by the Fourth Circuit. That very same month, we won a jury trial down in Cincinnati, so something, again, that I had pioneered, actually having jury trials for tax cases. We won a jury trial, and then we won a case here in Cleveland against a local bank and a Pittsburgh bank here in Cleveland in May. So we had our 3 cases. We put out a settlement offer in August that basically said the taxpayer would have to pay 95%. In other words, you'd get 5% of the benefits you thought you were going to get, and virtually every company accepted it. A couple that didn't went on to litigate and lost their cases. So basically what we did was we ran the table in 2 years and eliminated a whole group of cases, brought in billions and billions of dollars for the federal government. In the old days, that would have taken 10 years to work through that inventory or more, okay? And this was very effective and I think will be a tool that the IRS will continue to use in the future. Now, in addition to all the things I've talked about that we control, there were a number of other factors that I just want to mention that played a role in this. All right, one was the Enron scandal, because it led to Sarbanes-Oxley being enacted. You ended up with the Public Company Accounting Oversight Board, which then put in very strict standards for accounting firms in terms of enhanced auditing and professional practice standards. The SEC came in and promulgated auditor independence rules. The FASB came up with, the Financial Accounting Standards Board came up with what was called FIN 48. I'm going to talk a little bit about that in a minute, but it required companies, before they could take a tax benefit, to feel that they had more than a 50% chance of winning, more likely than not a chance of winning the issue. The IRS subsequently came up, built on FIN 48, and came up with a form that's now attached to all the large corporate returns called the Form UTP, where you have to self-report any transaction where you've reserved for financial accounting purposes. You don't have to say the amount, but you have to report the transaction. So what you're doing is you're providing a roadmap for the IRS, okay? So there were a number of other things that happened around that time or after I was chief counsel that have led to this major change, in my view, of the way people look at the tax system, from what Larry Gibbs said back, or talked about back in the late 90s to where we are today. So I'm kind of concluding the first part of this talk. As I look back over the 40 years I've been practicing, we've been through 2 tax shelter cycles, the 75 to 85, and also the corporate tax shelters in the 90s. We've been through 2 periods of increased enforcement efforts after the 86 Act, where a lot of this stuff was just outlawed, was one way to do it, changing the code. The other is what we had to do, just do a lot of hard work to convince people that they were going to fail if they did this kind of activity. We also saw a resurgent IRS over the last 5 to 10 years, okay? But I don't know if we'll have time to talk about that. Right now, because of the what people call the 501c4 scandal, you really wonder if that's kind of the first crack in having the IRS return to some of the ways it did things back in the late 90s. And also, as you'll see in a moment, the role of tax advisors has changed dramatically to the point now where the IRS has put us as tax advisors in the position where we're really the first line of defense for the IRS, okay? And let me turn to that topic now. Let's talk about what are some of the trends that are facing our tax system going forward. What are some of the things we ought to be looking for right now, okay? Before I talk about the tax advisors, let me mention one other one, which probably is the most important of all. And that is, we are we are in an era of transparency right now. All right, what do I mean by that? Well, there's a cornerstone principle that when you're trying to combat the proliferation of abusive tax shelters is that the tax administrator has really lost the battle once the tax shelter product has been sold. And the reason for that is if the taxpayers purchase it, well, the tax administrator has to identify that taxpayer, has to audit the taxpayer's return, has to discover the tax shelter on the taxpayer's return, and oftentimes in the past they were hidden, and then you have to fight with the taxpayer about whether or not the tax benefit was already justified. So you've really got to come up with some way, and this I think is the key to what we did, again for the next time, is you have to come up with some way where you can put some tension into the system so people don't invest in these kind of things at the beginning, okay? And think about it. The tax administrator, the tax authority can't be everywhere at once, can't look at every single transaction. So you have to come up with some checks and balances, some built-in tension in the system that will basically raise the stakes so that any abusive tax shelter that is invested in will be identified by the IRS. And the economic cost will be such that it wasn't worthwhile to get into it, because not only will you have to pay the tax, but you have to pay penalties, you have to pay the promoter to buy the thing, you have to pay your advisors to get you out of it, and the economic cost will be so overwhelming, it just should not be done in the first place, okay? And so the conclusion that the IRS came up with and I thought this was pretty clever, was to make these transactions transparent to the IRS, with the idea that if the IRS, if the tax authority is going to know about these from the beginning, then people won't do it. They won't invest into it. And I used to, in my speeches quite a bit, talk about this as saying sunshine is the best disinfectant. And that's what, when you think about it, and that's not something I made up. Justice Brandeis made that comment in a book he wrote before he became a Supreme Court justice. So the idea, if you shine a light on it, people will stay away from it, okay? And so what came out of this thinking was a disclosure regime, okay? That actually began before I became chief counsel, first by regulations and then by statute, where taxpayers, the promoters, tax advisors are required to self-identify and disclose to the IRS certain transactions where the IRS believes there's a high risk of non-compliance. So how is this done? Well, the IRS publishes as soon as possible a description of the transactions that it's determined to be abusive. And then the material advisors, which includes us, are supposed to register those before they market them, and they're also supposed to maintain lists of all the clients or customers that they sell these things to. And then the bottom line is the taxpayers themselves are required to affirmatively disclose and highlight these transactions on their income tax returns, okay? Basically, you have to attach a form that has a name, 8275 or whatever it is, but in a sense it says, please audit me at the top, okay? That's the idea. And let's take a look at, well, one of the ways the IRS does that is through the Schedule M3 for corporations, which requires corporations to identify the differences between their profits for tax purposes, their profits for financial accounting purposes, and frankly, that's where FIN 48 came in, okay? FIN 48 is financial interpretation number 48, and what it does is requires companies to look at their income tax risk in their audited financial statements. They've set a threshold, so you have to reach a conclusion that it's more likely than not, which is more than 50%, that you'll be entitled to the tax benefit. If it's less than that, you can't take it at all, okay? And even if it's above that, unless it's 100%, you have to reserve some amount. There's a complicated formula you use to do that. And what the IRS did then is the IRS built on it. It was pretty clever. In 2010, the IRS came up with the Schedule UTP on certain tax positions, and basically they said that if the taxpayer on his financial statements has identified reserve items, they have to disclose them to the IRS. And again, providing the roadmap for the IRS for those particular items, okay? So you can see how the IRS is now using these tensions that were built into the system by FASB to help itself with these tax shelters. And so the bottom line on this transparency point is really over the first decade of the 21st century, you know, based on this idea disclosure is the best disinfectant, and requiring the disclosures on the tax return and all this other stuff, it's really supposed to have a prophylactic effect on the behavior of taxpayers, presumably resulting in them shying away from purchasing these things. And I can tell you from my experience working in New York primarily, it's pretty clear to me that that's what's happened. The world has changed dramatically from what was going on 10 years ago. People really take this very seriously, and they understand, I'm talking about the tax advisors, their advice is not the kind of advice that was probably given 10 years ago that led to a lot of companies having trouble with the IRS. Well, let's turn then to the IRS delegate, or deputizing all of us as in its first line of defense, okay? The best example of that is FIN 48. Okay, why is that? Well, the big four accounting firms now find themselves in the position where they have to monitor those positions, and they find themselves arguing with their audit clients whether any of the benefits they take meet this more likely than not standard. And as I said, if they don't meet the standard, then you have to figure out still some amount has to be reserved. They have peekaboo, the public company accounting oversight, but looking over their shoulders, okay? So they're very concerned. And so you have this really anomalous situation. We see this a lot, where we're called in because the accounting firm is taking a much tougher position then we think the IRS would actually take on a matter, because they're so concerned they'll be criticized for saying something works when in fact really doesn't. So what has happened there? The IRS has in a sense deputized the accounting firms to require to have more conservative advice given to clients, and that's where this UTP form really came in, because that then directly goes on that form, okay? Another place where the IRS is focusing on keeping their eye on tax advisors is Circular 230 that I talked about earlier, which governs the practice of tax law by attorneys, CPAs, enrolled agents, that sort of thing. And practice is very, very widely defined. So they set forth certain minimum standards, and over time they've ratcheted these up, okay, to the point now where, particularly in the last decade, it really had very strict standards for when you give an opinion, what had to go in it, what was involved, and by its nature caused people to basically give more conservative advice, or certainly be less aggressive, okay, because they had to follow all of these rules. And by beefing up the bureaucracy that monitors Circular 230, this Office of Professional Responsibility, again, tax advisors know and take very seriously what these rules are and monitor them very carefully. In our firm, every month we have to report in whether or not we gave certain kind of advice. I'm sure it's done in every firm, right, Tom? Everybody does that now. And so there's another way to kind of have the IRS keeping their eye on the practitioners, remember, who then are the ones who are supposed to coerce, too strong a word, but to make sure the taxpayers take the appropriate positions. A third tool that the IRS uses are penalties, okay, because it's always not a very good day when the IRS wants to reach in your pocket, not your client's pocket, but your pocket to take money out, okay? And so there are penalties that apply to tax advisors, and they have been made stronger over the years, particularly in 2007. Up until that time, a tax advisor just had to feel comfortable there was a realistic possibility of success, basically a 1 in 3 chance that it was the right advice, okay, that was the correct answer, and they could give the advice and not run into a penalty. Well, in 2007, Congress changed a law that actually required them to meet this more likely than not standard, which was really a strange situation, because for a period of time there, until Congress went back and brought everything into sync, the taxpayers themselves only had to meet a standard of that they had appropriate authority. Okay, they had what was called substantial authority. If they met that standard, which didn't even have to be 50%, maybe you had a 40% chance, okay. If you met that standard, the taxpayer wouldn't be penalized, but here the tax advisors had a higher standard. And so there was a period of 7 months or so where actually it was better off for companies not to consult their tax advisors, because they could be told, the tax advisors would have to tell them it doesn't work, when in fact they still might be able to take it without a penalty. Again, that was changed, but the point of all of this is that, again, trying to make tax advisors be less aggressive so their clients will be less aggressive. So in a sense, the way I look at this is the IRS has really deputized us as tax advisors to be the first line of defense for the IRS. And when you think about it, that kind of puts us back in the position we were when I started practice. Certainly in the 1960s, when the advice was more conservative, I think we've probably returned to that period. That's kind of the bottom line here. Okay, let me go through a couple more trends here, and then maybe we have some time for some questions. Electronic filing has become a very important tool for the IRS. Individuals have been able to do this since the 1980s. All companies, all large companies since 2005 have had to do it. And why is this important to the IRS? Well, it cuts off many months of the audit process. Theoretically, the day after the return is filed, the IRS could start auditing it, okay, instead of taking 2 or 3 years to get the return together and get in there and look at it and everything. And that's important, because the sooner you get onto a problem, the better off you are. But the more important thing, and we haven't seen enough of this yet, and I think it's something we're going to see more of, is it allows the IRS to develop sophisticated analytical tools to better select areas of audit inquiry. Okay, so what they can do is they can look at, let's say, a cross-section of financial institutions and run through their computers and figure out what the average return should look like. And then they can look for banks that are on either side of that, where there's an aberration, and they know those are ones they ought to look at because there's something that could be amiss here, okay? And they could do that with any groups of taxpayers they want to. They're not there yet, I can tell you that, but that's an aspiration, and I think that's something that's going to happen in the next couple of years. Okay, let's focus on what the IRS believes to be its largest controversy challenge, and that is international cross-border transactions. If you're a young lawyer today, this is what you want to get into. You want to be dealing with international tax. And it's a problem not just for the IRS, it's really for tax authorities around the world. And what it's all about is what's called tax arbitrage. In other words, you have different tax rates in different countries, different domestic laws. And so what you try to do is you do your tax planning so that you have your expenses, your deductions in the high tax countries, and you have the income earned in the low tax countries, okay? That's really the big thing right now. It's gathering steam. Transfer pricing, you may have heard about transfer pricing. That's really what that is, because what you're trying to do is measure profits where you have a parent-subsidiary situation where the parent's in one country, the sub's in another, and they have transactions back and forth, okay? Where do you want the profits to be? The companies are going to want to put them in the places where the tax rates are the lowest. And what you're supposed to do is you're supposed to set up some arm's length principle. You're supposed to have some standards you judge it against. Transfer pricing disputes are going to be the most contentious area for the near future in tax administration, because primarily other countries now are catching up to the IRS in how they're doing it. A lot of what we did was we worked quite a bit with other countries when I was chief counsel, and they've continued to do that. So other countries are now getting to the point where we are in this country, and so I think you're going to see many more contentious transfer pricing audits. And finally, the third problem is stateless income. And I remember the person who's head of the UK tax authorities, become a good friend. My wife and I were over there last month, and we went out to see him, we were talking with him, and he said one of the things he worried about the most before he retired, he's retired now, was this idea of stateless income, that people are trying to locate profits, income in countries that have no tax rate, zero, or very, very low, and it's really not taxed anywhere, okay? And so how are international tax authorities, how are the countries trying to deal with that? Well, one of the interesting things is they've taken a page out of our book in the IRS, and a lot of them now have put in information reporting regimes, or these disclosure regimes, okay, just like we have here. The UK picked up on it. A lot of the others are. You can look at an OECD study, I mentioned in the outline here, where they've gone in and looked at each country and what are the reporting regimes that are being put in there. The latest idea, this is kind of interesting, is to have country-by-country reporting, where what you have to do is you have to break your corporate operation up into finite pieces and report what your effective tax rate is in each country. So it'd be evident that maybe in the UK you're only paying 10% when the nominal rate may be, or the marginal rate may be much higher, okay? There's also cooperation among international tax authorities. This is a new trend that's really picked up steam. One of the things the IRS did in 2004 was set up a tax shelter task force with the UK, with Australia, and Canada. Now China's joined it, and South Korea's joined it, and Japan. And what they do is they don't work on cases, but they share information. So the whole idea is if something pops up somewhere, okay, chances are it's going to pop up another place. And so they share information to try to get on top of these. There was one case where I went to an ABA tax section meeting and heard a debate about an idea that sounded to me kind of strange. I didn't think it would work. But I was told that the presenter mentioned in the UK that it had been approved. So I called up the head of the UK tax authority. We got the equivalent of the Department of Labor, PBGC, the IRS, and their treasury. We all got on the phone together and we talked through it. And sure enough, what was happening is one of the accounting firms was developing a product, test marketing in the UK, and then was going to move it to the United States. And what we were able to do with that information was to put out guidance that stopped it in its tracks. And so you're going to see more and more of that kind of thing among tax authorities. You're going to see more tax information agreements. Frankly, the real proof of this is the G20 in February last year actually issued a communique where they all pledged to combat tax avoidance by multinational companies. Think about that. So now you've gone from the tax authority level to the much higher political level. And I guess that's best illustrated to what's called the BEPS project, based erosion and profit sharing, BEPS, or profit shifting, base erosion and profit shifting. You're going to see a lot about this because this is just a fancy name for tax planning where you seek out to put your profits in your low tax jurisdictions, okay? And there have already been hearings in the UK where before the Public Accounts Committee in the House of Commons, Google and Amazon and Starbucks were brought up and become poster children. Over in the UK, it's quite different here. They still have 10, 12 newspapers, national newspapers, and they love this kind of stuff. So it's called naming and shaming. So they really made a big deal about how Starbucks was everywhere, but they were paying no tax, okay? And same thing for Amazon, because they have all their IP located in Ireland, and they're paying very large commissions back to the for the use of the patents, that sort of thing. Okay, all totally legal. And I'm not saying this stuff's illegal. It's just out there, and that's what happens when you have the world the way we have it right now. And the same thing's happened in the United States. The Permanent Subcommittee on Investigations has called up Microsoft, Hewlett-Packard, Apple, and I think just this week Caterpillar was called up to explain this kind of thing. So I want to kind of give you that background. It's called BEPS. What's going to be interesting to me, though, is how you deal with that, because we're talking about sovereign countries, okay? And are they going to be willing to change their domestic laws to benefit the whole group? And aren't they going to want, they're going to want their share. They're not going to want to work with everybody else. They're going to want to try to get the most of the tax being paid in their country. UK is a great example. Here they're having these hearings, and they're really attacking the U.S. companies, but they're running around the world marketing themselves not as a tax haven, but a very tax-friendly country. They've been reducing their taxes. They've been putting in things that are trying to encourage companies to move from France and other places in Europe to the UK, okay? So if instead of working together, everyone kind of goes at this alone, we got a huge problem because you're going to end up with double taxation. You're going to have a situation where you're going to end up paying taxes on the same income in two different countries. And that's a recipe for disaster, okay? So any young people here who want to go into tax, that's the place to go. Our daughter, actually, out of Georgetown, went to Shanghai to spend the first 3 years of her career working on transfer pricing for an accounting firm over there. And you know, as I look back, I did not encourage her certainly encourage her not to go to law school. I didn't encourage her for tax, but she just picked up on this. And I guess if you're going to pick up on one area, that's a good area, transfer pricing. Okay, let me just switch to one last thing. I want to cover, you can't really have a talk about the future of the tax system without mentioning the possibility or probability of fundamental tax reform. So let me just spend a couple of minutes on that. And this has kind of been a topic in the industry, I'd say, since the mid-1990s. In those days, the talk was focusing not only on revising our current tax code, income tax code, but also looking to something different, a flat tax, a personal consumption tax, a value-added tax, national retail tax. And there have been a number of presidentially appointed commissions looking at this in the last decade in particular. Bush had one, Obama had one. There's been a whole series of these, and I actually list them in the outline. But nothing has really happened, okay? And at this point, I think, you know, some people are saying you need a grand bargain where you'd have a problem with the deficit, entitlements need to be reformed, the budgeting process, and tax would be part of that. Well, that really never happened, and probably would not happen short of a presidential election, so we're at least 3 years away from that. In order to have tax reform, you need presidential leadership, and the current president's really not interested in it, so it's not going to happen for at least 3 years. And there's a number of big picture decisions that have to be made. You know, the Democrats want to raise taxes, cut defense spending, increase spending on entitlement programs. The Republicans want just the opposite. They want to reduce taxes, reduce domestic spending, and of course, repeal Obamacare. A much bigger decision, though, those are issues, that's been true forever, those two sides. A much bigger issue you need to keep your eye on is internationally, because we are the only country in the world now that taxes worldwide income. So all our companies get taxed in the United States on income wherever. And the trick is you leave it overseas, you get to defer that tax until you bring it back. So you probably read in the paper about all these companies that have huge amounts of capital offshore. Well, that's the reason for that, okay? Something has to be done about that. That's a big sort of decision has to be made which way you're going to go on that. And again, there's some people on both sides, and both parties actually on both sides of that. And then you also have to make decisions whether certain sacred cow tax benefits should be made in place or repealed. And we all know what those are: employer-provided health care, home mortgage interest deduction, charitable deduction, state local taxes, that sort of thing. One thing I'll mention is I mentioned, and I have in the outline, all these different studies and commissions that took place in the last 10 years. They do serve a purpose, even though they haven't led to anything yet. What each one of them does is they put more things kind of into the process. I'll give you a good example. The home mortgage deduction was just considered sacred. You never touched that. Well, the Bush Commission actually came up with a proposal to change that, okay? So once that is out there, it becomes part of the discussion, okay? A good example is in this camp bill, this one that was just recently issued. He took a look at advertising expenses, and he says, well, maybe you should capitalize a portion of that. You shouldn't get a current deduction. I'm sure the people at Procter & Gamble and Unilever went nuts when they heard about that. But again, now that's an idea that's out there. It's no longer something that people won't talk about. So it's important to kind of follow that and understand that all of that stuff is really on the table when they finally get around to a fundamental tax reform. When do I think that's going to happen? I've always had this theory, almost done. I've always had this theory that the only time you could do fundamental tax reform is in the 5th and 6th year of a 2-term presidency. That's when it happened in 1986. That was the 5th and 6th year of Reagan's 8 years. And the reason is the president's been reelected, not going to run again. There's not going to be another presidential election for 4 years. It's going to be at least 2 years before you have midterms. There's this window of opportunity where people can make some tough decisions, okay? So if you follow that theory, then we're really not talking about 2017-18. We're talking about 2021-22. So I guess I'll leave you with that, and maybe we'll be back in 2022 to talk about the brand new Internal Revenue Code of 2022. Thank you. We have a couple of minutes here for questions. Anybody like to ask any question? Yes?
Yes, are the IRS databases considered inviolate?
That's a good question. That's a real good, I'd worry about that because you have so many contractors who are hired to work on these things. You know, remember what happened with the veterans database a few years ago, and there were a bunch of tax records in there. Same thing happened in the UK. You know, personally, I don't know. You know, that's something I didn't work on, but who knows? And that's why with Obamacare and all these additional duties being put on the IRS, you increase the opportunity for that kind of thing to happen.
If that were to happen, like hypothetically, let's say an elderly person was deleted from the IRS database, maybe an IRS employee thought, well, looks like the person is being probated, let's tax a family member. Does the IRS have that discretion sort of manipulate the outcome because they think something's going to happen and this would be the way to resolve it tax-wise, like you were saying?
No, that would happen. You get to the real facts. If the person didn't die, they're not going to be.
It would be eliminated, like from a database.
Yeah, I mean, you know, maybe someday the tax code will give everybody a one-time election to consider themselves dead. You know, but it'll only be a one-time election. That'd be it.
What do you think is going to be the next scam that's going to be people will try to put on the IRS? Also,
you mean on the IRS on taxpayers? I mean, the thing you got to worry about is identity theft. Okay, and I understand the big problem, I hate to say this, but the big problem, as I understand it, is all your medical records, which have all your Social Security numbers on them. Somebody goes into a doctor's office and steals all those records and then uses those, and this has been done, to file refund claims and try to get tax refunds for you. I heard of a scam last week on the radio where people are calling up elderly people and saying, look, I'm the IRS, you owe me a certain amount of money, give me your credit card number so I can charge it, and so you can pay me. I mean, you're always going to have that kind of stuff.
The second part of the question would have been, what is the next little spiel that you're going to hear from the tax resistors? You know, like only allow you've got to pay the gold or something.
Well, you know, when I was there in the 1980s, when I was the assistant commissioner, tax protesters were a big problem. I will tell you, when I was there as chief counsel, that really wasn't a problem. And we were focused on much bigger problems. And I'm not so sure that's as big a problem as it once was, okay? And one of the things, yep.
Can I go back to your comments about the aftermath of the 86 Tax Reform Act? And you mentioned that at that point, when the new literalists came in and read the code very much according to what the language was and kind of shunted the judicial doctrines off to the side. That was a period when, more generally, people who were thinking about statutory interpretation were focusing more and more on text, less and less on things like legislative history and judicial doctrine. I realize you were on the tax side of this, but do you have a sense about how those developments might have been related? That might the more general skepticism about legislative history and sort of non-textual affected the tax side, or is it the tax side maybe affected the other, or is it just a coincidence?
Maybe just a coincidence, because I think, I mean, there were a certain group of lawyers who were trained that what you do is you're much better off with a very complicated statute, a very lengthy regulation, than just a short, here are the basic rules. Because you could sit down and kind of weave your way through it to get from point A to point, the idea was to get from point A to point E, okay? And every step worked. But if you looked at the end of the day where you were, no one would say, in their right mind, would say that's supposed to work. That's really what was happening. In other words, they were putting transactions together that would take, there'd be several steps, and again, each step would work. But then when you got to the end of the day, no way would it work. And that's what the judicial doctrines really are there to I used to always call them an overhang on the statute. And one of the things that happened while I was there was a real effort made to codify one of the judicial doctrines called the economic substance doctrine. And I opposed that, which is really kind of unusual. There were a number of times where I would kind of say things that seemed totally inappropriate for the tax administrator to say, but I very much opposed doing that. And the people on the Hill couldn't figure that out, couldn't figure out why. You know, why we're giving this to help you. Well, what I was concerned about is once you put it into the statute, and then 15 years from now, when people get back to this, they take a very strict constructionist approach, they would basically say, well, look, here's what the statute says. This transaction, you know, this works for us, okay? By having it being a judicial doctrine, on the other hand, it's a living, breathing kind of thing, and judges can adjust to the situation at hand, okay? And so we'll see. I mean, you know, the Congress, it's interesting how this one guy from Brush High School, Lyndhurst, Ohio, was able for 2 years to stand in front of Congress and oppose that, and it didn't pass. And it wasn't until, actually they sneaked it into Obamacare in 2010. They put it into the law. And I would say most tax practitioners, most tax academics, maybe I'm getting a little ahead of myself here, probably didn't think it was such a hot idea. In other words, they kind of agreed with me, you're better off where you were. Okay, so sometimes you gotta be careful what you do.
Please join me in thanking God for Mark. we have a little token of our appreciation, and there will be a reception right around, so behind this wall, so please join us for a reception with Don, and thank you again for coming.
Thank you.
Thank you.
Oh, I don't know.